All right, welcome everyone, and welcome to our today's session. So today we are going to look at what happened in the first quarter of 2020, in a very turbulent quarter. We are going to look at that on a more top level view, but then we're also going to zoom into various sectors and specific companies. So we're going to look at all the good, the bad, and the ugly. Guiding us through this session today will be Thomas Michael, who is head of advisory at Kristal.AI. And this is the perfect time if you have any questions. So that's very important. Please at any time use the Q&A tool. So you should find a little Q&A icon on the top or the bottom of your screen. So you can use that to type in your questions anytime, and we will pick them up during this call. Or if you prefer talking, you can just raise your hand. So there should also be somewhere a button to raise your hand, and I will unmute you. If you have any other questions left after this call, in any case, please always contact or send an email to your relationship manager. And in the unlikely case that you don't know who your relationship manager is, or you don't have one yet, you can always just send an email to support@Kristal.AI, and we'll be happy to answer all your questions. One important thing, this session will be recorded. So in case you have to drop off, or you can just resume the recording afterwards, we were going to send this across. Or if you also want to, you can send it to your friends. So with that being said, I will hand over right over to Swapnil Mishra, who is our head of private wealth, and then hand over to Thomas. Thank you.
Thank you so much, Barbara. A very good evening, and very excited to organize this. We're calling it a roundtable, more so to emphasize that this is something which we are doing it very exclusively for our private wealth clients, and hence, in fact, if you don't have a relationship manager, then clearly we have a problem, because all the invites have gone through the relationship managers. The idea is to, in a very, of course, we have access to all reading material in terms of what is happening in the earnings season. But, of course, apart from reading long literature around the earnings report, we thought it would be a good idea. I was talking to Thomas. Thomas is our head of advisory, and we said, why not do it in a very special manner and share some of the insights which will help in the investment decision-making process. So ultimately, some of the discussion today will act as a foundation or a framework for the decisions. And I know that there is a flood of webinars. I mean, really, everyone's just waiting to get back to life. But this is a format which works. So we decided to invite clients for this. So Thomas, over to you to share the screening of the good, the bad, the ugly.
Fantastic. Yeah. Hey, thanks very much, Swapnil. So, yeah, very good afternoon. As Swapnil and Barbara have mentioned, I mean, this is also a little bit of a high-level view, I would say, in terms of what has been happening so far in the first quarter. We have now reached a point in time where we have around 95% of the companies have reported so far, and that gives us at least some insight into what has been going on in the lockdown. Also worth to note that our lockdown started in most parts of the world. I mean, Asia has been first in line here, but most parts of the world, like US and Europe, around early to mid-March. So even by looking at the first quarter earnings for those companies which have reported early in April or mid-April, the full impact here is not yet visible. So a lot of these things that we are saying are also subject to change. And I also want to put a big disclaimer onto it to say that whatever data and views are represented here have to be seen with a very high amount of uncertainty. Yeah. So we have, I think, but what the market is currently into is, I hope that everybody can see my screen, right? Yeah. Good. So what we are currently going through is a great amount of uncertainty. And I think there are three factors that will determine where the markets are going to go in the future, or have determined already where we are today. Number one is monetary fiscal stimulus. I think that by far and large is the biggest driver of that rebound move that we have seen. Second big driver is going to be the developments on the virus front, whether after lockdowns are eased, infection rates go up or not. New stories about a vaccine will lift sentiment certainly, and how quickly will the economy revive, and how deep is going to be that recovery. And that's directly conditional to how does this transition into company earnings, which are ultimately, when we're investing in equities, our drivers for any capital appreciation that we have in the long term. So we have entered the deepest and fastest shock ever. And what we try to do is that we derive some signals, and also to give you an overview as to what's our view on some sectors that are doing relatively better or worse. Having said that, no one has been spared. I think all our lives have changed in the last 3 months, and they will definitely change in one way or the other going forward. And there's, again, brings me to this uncertainty ahead of us. I personally, I have my doubts, even when we have a vaccine, that this throws up another amount of questions as to who decides who gets it first, and how is it going to be distributed across the globe, how you're going to vaccinate, I don't know, in the developed world, maybe, let's say, around 4 billion people. Yeah, so there's a lot of uncertainties around that, a lot of question marks, and that makes it interesting, at the same time incredibly difficult at the moment to be an investor, and even more difficult if you're a trader. So the shorter the time frame, the more tricky it is sometimes. So I wanted to give you a quick overview into how have earnings across sectors been. And also we have tried to contrast this with what's the year-to-date return for these sectors, based on sector ETFs that we have looked at. Also, one caveat here, the data, unfortunately, that's from 15th of May, so that's, some of it is already a little bit, has moved from the current levels. So in healthcare, we have swung to a positive year-to-date number. Technology has rallied even further. So there's a few changes here, but broadly speaking, I think this picture is still in line with what we have seen. We've also seen some prominent victims that have already been claimed, like Virgin Australia, for example, or in the department store space, Neiman Marcus, JCPenney, even some surprisingly, some tech companies like Intelsat and Frontier Communications couldn't shoulder the debt burden that they have loaded onto the balance sheet and filed for Chapter 11 in April. So I think the bankruptcy, or the companies that have filed for bankruptcy protection are very well represented in this big losing sector of consumer discretionary, where we see a breakdown in Q1 earnings of over 50%, compared to the same period of last year. Yeah. There's also no real surprise that healthcare and technology are the big winners. That's driven by the shift to cloud. I found it very interesting if some of you read the Q1 earnings release from Microsoft, where the CEO has said that what has happened in the last 6 weeks has propelled the technological advancement and the changes in technology for what we would have usually needed about 2 years. And he was referring to the move to cloud computing, everybody working from remote locations, that has kind of like changed the way how people are working. And that was something that some tech companies had projected to happen over the span of 5 years. We are probably, or 5 to 10 years, we're probably going to complete that transformation in the next 2 years, just out of necessity. So some interesting comments here. Consumer staples, the third one here, I also find this interesting in a way, because you see here the Q1 earnings are actually still positive. Year-to-date price performance and return has been negative. Now, the earnings, I looked into some companies like Procter & Gamble and Johnson & Johnson. Here, big caveat is a lot of these companies have reported very early in the quarter. So we saw earnings coming in as early as like second week of April, and the closed books as of 31st of March. So the full impact has not been reflected in there. Also, the mix of some of these companies is also worth to consider. There is beauty and healthcare products are suffering while household goods and so beauty products are suffering while healthcare and household products are doing reasonably well. Same also in the real estate sector. I think the positive 2.7% that we have seen, it's a delay. A lot of tenants have stopped paying rents, and same sector in the utilities. I find utilities also interesting in a way that here that there's definitely a basis effect from last year, where last year Q1 earnings have been extremely weak in the utility sector, and a lot of utilities companies have been able to, towards the end of last year, which has boosted earnings on a year-to-date basis. Outlook here is, I would say, cautious, but it's still one of the better sectors, interestingly enough, for the Q2 outlook, and I'll get to that a little bit later as well. But a lot of utility companies have refrained from cutting off services during the lockdown periods for humanitarian reasons. So that will be a drag on earnings for the road ahead. I think the one sector that stands out as really interesting is the energy sector. For all the sectors here, the energy sector stands out where the year-to-date return has by far actually been worse than what the earnings have been. We had some positive surprises from companies like Exxon. And I think this is one of the themes that we have had, where we had a pretty strong view at the end of April, that with the oil price so low, what has happened post the Russia and Saudi Arabia agreement, another factor was that production has been shut down and the oil price has rallied back substantially. So I think the strong companies in that sector, we will see a wave of bankruptcies in the shale gas segment in the US, but the well-capitalized and strong companies are likely to come out stronger from this crisis here. So diving a little bit deeper into the good, the bad, and the ugly of our title of our little roundtable here, healthcare and technology. The big tech companies, I think they tell us a good story about what's going on and what I said early on, that nobody is spared. In particular, I was surprised by Amazon earnings when they have reported at the end of April, with a very negative outlook for the second quarter, or I would say actually for their standards negative. And the problem here again is it's not really reflected in the pricing. The market prices are really priced for perfection for a best case scenario, but even the company, certainly they are coming in as low as possible, because their benefit is if they beat earnings, because that leads to a positive earnings surprise, always leads to positive price movements, which is good for shareholders. But nevertheless, details in the statements about the costs that has increased for them to protect their workers shows that for companies where we have thought, or the broad market has thought that they are the big winners, is going to be challenging to monetize it. Yeah. I think also Facebook stands out here. The Q2 forecast has been brought down significantly, but Facebook has made some very recent announcement, very interesting announcements around their strategy in India that they have made, and also with their shop expansion. That is already a response of the company to the changed environment in technology or the changed environment in retail, which could make this quite interestingly in the quarters ahead. The two positive ones were Apple and Microsoft, definitely. Google in itself also, I would say, I think Google Cloud's segment has been very strong, but these are kind of like those 5 key pillars of the tech sector, which have also been cautioning towards the second quarter and going into a more defensive outlook. In the healthcare sector, we had 5 big healthcare companies have comfortably beaten analyst estimates. United Healthcare Group, for example, was one of the ones we took a closer look. They raised their 2Q second quarter forecast even. This is an insurer, but for healthcare services. But for this company, there's one big overhang, and this is also something generally for the healthcare sector, a very differentiated picture. There's a lot of bullishness in the market at the moment. Who's going to find a vaccine, and that's definitely supporting a lot of companies. But question marks are around companies like, for example, United Healthcare Group, which is providing health insurance for employees. With unemployment rates at these levels, companies will pull back on the spending there, so that will be a headwind going ahead. Yeah. The second part is hospitals and healthcare REITs are also under pressure. That's been consequence of the lockdowns that we had, and the fact that in the US in particular, hospitals have literally stopped, or not literally, they have stopped 100% of elective surgery, which is usually a very strong income stream and revenue stream for hospitals and healthcare providers in the light of the crisis. So that has been a big impact on the earnings, and we have to see with the opening and of the economy, and with the easing of the lockdown, how infection numbers develop, and there will be very high correlation in that. Going to the bad's definitely financial sector. I think financial sector is going through its challenges, a little bit of a double whammy. So I've been saying this, some conversations that with some of you who've joined our webinar, that this is the difference between 2008 and 2020 is that this is not a liquidity crisis, this is a solvency crisis. We are going into very sharp slowdown at a time when we had record levels of debt on the corporate balance sheets, which was driven by share buybacks, leveraging up balance sheets on the back of low borrowing costs, etc. So with that in mind, there will be an increase in bankruptcy rates, no doubt, and we have seen this already, as I mentioned earlier on. There will be more to come in the quarters ahead. And banks have taken a very strong stance in increasing the loan loss reserves on the balance sheets, which has impacted earnings per share in the first quarter. So if you're looking at JP Morgan's earnings, which are one of the better ones, I have to say, their earnings per share has been revised down substantially. And the interest margin is also under pressure. That's driven by mainly flattening of the yield curve that is taking place and is likely to remain in that shape for time to come. Because I think the next 6 months at least, we will still see a lot of deflationary pressures. My long-term view, and this is like 3 to 5 years ahead, is more in inflation will emerge at some point in time, subject to certain conditions, but the near term is actually quite deflationary. So yield curves, I expect them to stay flat or flatten even further from where we are in the coming weeks and months. And so that's going to be a headwind for bank earnings and the financial sector in months to come, and also for the next quarter. Consumer retail is definitely the ugly So based on Refinitiv data, we have seen, there's no surprise here with everything in lockdown, but department stores have seen basically revenue dropping to zero throughout April. JCPenney filing for Chapter 11. Hertz also is about to file for bankruptcy. Actually, I haven't checked this morning whether they have filed already or not. But retail is definitely going through a fundamental shift, and those which are able to adopt to technology and are changing the business model are going to come out as survivors. So Costco actually, or Walmart, they had reasonably good earnings, I would say, in the overall bunch, but the conventional department stores are under significant amount of pressure here. Last but not least, this is something that keeps me up at night. So this is the forward price earning ratio. As I mentioned, the Q2 earnings, so while we have seen on average about a 17% drop in the first quarter earnings, the outlook for second quarter, given that pretty much all of April was gone, is even more severe. So based on Refinitiv data, the average for the S&P 500 is an earnings drop of about 42% in Q2. And that puts the 12-month forward PE ratio for the S&P 500 to, on the 11th of May, it was 23%. It has come down a little bit. We're currently standing at about 21%, because some companies that have reported last week, like NVIDIA, they have actually increased their outlook or held it stable. So, but it is still, I mean, if you look at the chart, we are in territory that we have last seen 2000, 2001 at the dot-com bubble. Yeah? And that's a big debate at the moment, given that we are in a zero interest rate environment. Doesn't that mean if we're discounting cash flows that we are able to sustain that growth rate or these kind of PEs over a prolonged period of time? But we will see what's the outcome. I mean, I'm looking towards Japan and Europe, where we have had zero interest rates and even negative interest rates and PEs and companies. And look at the Japanese stock market, look at the Nikkei, which is still 50% below its highs when the bubble burst there, or European markets, which are trading at also near sector lows or weight lows. So that's kind of like, in conclusion, I would say the keys are what will be spending and consumption post-COVID. From the looks of it, I think the easier ones to predict are technology and healthcare. But even here, I would say for healthcare, differentiated view, same as also for technology, is very important. And we are looking forward to news on the economic recovery regarding vaccine and that our lives normalize. But again, we need more evidence to go through that. So I'm going to stop here. I hope that was insightful, and let's see if we have some questions from our attendees.
I think I can see one question which is around for portfolios which are currently, so someone's asking if the portfolios are already long equities, then what's a better strategy to protect for the downside, or to replace it with some kind of strategy which allows participation if it goes up, but otherwise to stay out? So a more specific portfolio related question.
Yeah, so I think this is it's the billion-dollar question at the moment, yeah, because people look in the discussions that I have or the debates that we have also internally in the IC, it's always the question around what are we doing with interest rates? Is an offset of your fixed income allocation, is this going to work the same way how it has worked over the past 20, 30 years, where you did have in recession environments rates acting as a buffer? I do think that is still the case. Yeah, so I think it is still important for investors to consider fixed income as a diversification for the portfolio. Yeah, I mean, 30-year rates in the States are in US dollar are still at about 125 area. Yeah? So there is still some yield, I would say, but you have to look at it also from a real rates perspective. Given that currently rates are floored at zero and we have enormous amount of deflationary pressures, even if you get paid zero rates, you are on a real rate basis, it's actually quite good. That the risk is, or the problem will emerge once Fed will cut rates to a negative territory. That is then, I think, for me, I view this now more as a buy the rumor, sell the fact. Yeah? So at the moment, it's a good place to stay there. But if you go really into negative rates, I think there is a good argument to rotate into the other direction. With regards to what it means for the equity portfolio, we are looking into some sector rotations ourselves. And that's more driven from a differential between price versus the actual earnings. So if I look at Nasdaq is at highs for the year, yeah, year-to-date highs. If you look at the S&P 500, we are at around 61.8% retracement, where we're hovering around right now from the highs. But if you go down the food chain, if you go down to a Dow Jones Transport, for example, that's 30% retracement of the lows. Yeah? So that is hardly any recovery here. Yeah? Sectors that I currently like are, due to the defensive nature, for example, utility sector, as I brought it up earlier on. There's also another reason why I like utilities is that I think the round 2 of the fiscal spending will take place in infrastructure spending in the US. There's an enormous amount of lag in spending, and this is probably the easiest way to generate jobs. And we're seeing this in some countries in Europe happening as well. Like my home country, Austria, announced yesterday a 400 million euros infrastructure spending budget for the next 2 years in building out railways, in building out transportation infrastructure, public transport. So that's going to happen and support some of the more defensive sectors where the government can come in and spend. In technology, in healthcare. Look, healthcare, I think if people have been in there, it's nice to be in a Moderna, but or these stocks which have rallied so much, but there will be only a few winners. And as I mentioned in the introduction, I still have my doubts how companies will be able to monetize it, because there is such a high pressure of kind of like public interest. Even if you find a vaccine, are they able to monetize it in the same way, or will there be political and public pressure?
Yeah.
Because it's a huge reputational issue. If somebody like a Gilead charges $1,500 for a dose of their treatment, they will face a lot of headwinds. So that might lead to a very low margin and lower than what we are expecting today.
Actually, that then links to the other question that we have, Thomas, which is, should one go beyond the 5 stocks, the obvious winners in terms of tech and healthcare, and there's another question before that, which is, how does one go creating new long positions? So I mean, the way I see it, and of course I see it more from a problem that an investor is trying to solve. And the way I see it, the problems are twofold. One is, what are the sectors or what is the asset which one takes a decision to buy? So whether it's healthcare, whether it's utilities, and there is a lot of supporting argument behind these. The second is, what are the instruments that are used, or how is that participation done and executed in such a manner that it doesn't either expose to a significant downside risk or allows some kind of participation. So I feel in that case, at least accredited investors do have access to kind of tailor making some of these things to suit their requirements. So I think it's best to break it into 2 parts, which is picking the sectors and stocks, and then picking the instruments which may help.
Correct. Yep. Yeah, I think that's absolutely, I think, the right strategy going forward. It's a little bit from a top down, but even there, I mean, the sectors. Some people are feeling more comfortable if they look at a broad market. It's less risky. But I would say again, my views here is more on the defensive sectors. Again, technology, healthcare, they had massive run-ups. In the technology segment, I think there are a few companies that still have a lot of upward momentum for various reasons. I mentioned Facebook earlier on. I think they are actually, I never liked that company, but I'm starting to change my view. And I didn't like the company because I'm not using the product, but they have really made a transition, or are in the process of transition, that is quite interesting. And the other part in the technology sector that has been enormously profitable and has also been a big driver of earnings growth is the semiconductor space. Yeah? So semiconductor earnings in first quarter were up on average about 21%. Now, if you strip out semiconductors, I think early on the first slide I said tech earnings are up about 6.8. If you strip out semiconductor, which have been strong due to this entire shift to cloud infrastructure, the tech earnings are only up about 2% year on year. Yeah? So there's a big discrepancy between there. I think that with big companies like your Googles, it's a spot that is relatively comfortable for many. I don't see that much of a long-term risk here. Now, but for investors who have been very concentrated in these segments, I would say it is probably a good time to look into some rotation. Yeah, there will be a repricing. I think the price and the reality are at very far apart. That's again leading me to the forward earnings that I showed early on, 21 times forward earnings on S&P. And in the tech sector, it looks even more extreme. So I think it's not a time to sell out of everything because it's going to crash, but to go back into some of those companies which will also benefit from a reopening of the economy, which have been overlooked. Yeah, utility sector, as I mentioned, energy sector. Yeah, oil price is back up at 33. I don't think that oil is going to go back to 60 anytime soon, but as long as it stays in a sideways range, as long as demand picks up again here, same as in industrial goods and materials. Market is currently trading on hope that the economy will recover. So why haven't they recovered then? Right? There's for me, there's a little bit of a disconnect, and that's why I think from a long perspective, those are sectors where I would like to add or where I'm looking to rotate into here. Second question, products. We have made a great development and great stride forward on Kristal side in offering structured notes, but light structured notes in a sense that give the client the ability to benefit from it through various reasons. And some of the recurring themes that I see is that that people are actually quite cautious about the current levels, and majority of investors are expecting a pullback of 5, 10, 15%, whichever way it's going to swing. But at the same time, also looking to get back into the market at these levels. Yeah? And that's something that we can also offer. So we have launched yesterday, and I sent out something last night about downside participation notes, where you're actually making a net profit in the first 10, 15% of a downside move. You're getting a premium above the fixed coupon. And then if the stock at expiry is below the strike price, you would get delivery of the stock. And I think that's a very good way to express a mildly bearish view. That is something covering your break even is a good 15 to 20% below the market, depending on how we strike it. But that's kind of like what we are, what I think is in this environment, a decent strategy to do that.
Yeah, that's actually.
Or outright for longs, most important thing is always, and as she said this in one of the webinars before as well, is like, watch your tail risks. Yeah, I don't think this is the time to really increase leverage aggressively. It is always good to, given the uncertainty, I think the amount of risks has to be adjusted to the amount of the possible outcomes that you have, and what is the possible market impact here.
Yeah, I think that answers the third question, Thomas, which was around the chance of downside is quite high, and you've kind of already mentioned this point that hence protecting the tail risk is very important. I guess the only other aspect is that if there is a downside risk, there is the choice of course, selling everything and just sitting on cash. Now, that is then eliminating any possibility of participating. So, if the priority is also to participate, then there are ways and means in which these things can be done. There's a question on gold, which again, as an asset allocation, gold continues to remain very important, and it has clearly demonstrated that even through the extreme volatility that we have seen in the last few months, gold has been in a way a pillar of support in a portfolio to whatever extent.
Yeah.
Thomas, there's one question which is very relevant to the earnings, the whole thing we are discussing, that forward PE on US tech sector. Is it still looking attractive or is it looking overvalued?
I think it is looking overvalued. For me, this is at that point in time, I think that it is the incremental dollar to the upside is harder to. It's like going through a bicycle race for those of you clients who are avid bikers, and we have some of them amongst us. They will know that if you're riding a bicycle with a strong headwind, it's harder. You have to pedal harder in order to move forward. And I think this is exactly with forward price earnings at these high levels. It's like a strong headwind. Sometimes it doesn't necessarily mean that the market is going to crash. And I think some companies will be able to catch up. Reality will catch up to them in a way that the earnings increase to that amount as well. That price is again at reasonable levels. But in the near term, I do see this more as a headwind, and I think I'm struggling to say that Amazon is good value at 110 times forward PE. That somebody needs to earn that, no matter how good the business is, but that needs to be earned at some point in time. Yeah. There was also one question about gold. And the China-US situation. I think this is one very important point that has been raised. And although this topic was about earnings, but when I talk about things that keep me up at night, it is a geopolitical risk. Yeah. What's going on at the moment in terms of the rhetoric between US and China, also China tightening the grip on Hong Kong again, which is used by the US as an excuse to turn the screws tighter. It's a very good observation, and I think it's not far off the truth to say this is the new Cold War. What some of us have experienced as the Cold War between US and Russia is now the Cold War between US and China, and that will be a big impact, because still, and this is also a potential headwind for the tech sector, because a lot of tech companies also rely on the supply chain that is coming from China. We have seen this in the initial lockdown, actually, that a lot of semiconductor companies were struggling to get their parts because their supply chains are dependent on China. Tesla, a lot of the hopes are built on the Gigafactory in Shanghai. Could there be something? I don't know. Yeah, but it's something, a risk that's definitely there, and that is not reflected in the pricing right now. How this plays out for gold, I would say, I mean, I've been saying this for a year now, exactly in April when we started this, is that increase your allocation to gold in a portfolio. I still keep saying that we started off by saying 5% allocation to gold seems reasonable in the portfolio. We have rallied since then by a good 25%. So it has grown, but still, I think today, I see gold as an insurance policy for what lies ahead, even though it doesn't yield any income, but it is sort of an insurance policy against the debasement of currency, debasement of dollar. that is one of the possible outcomes of a Cold War between China and US. Yeah? Near term, I'm bullish on dollar. I think it's going to go stronger, but we are all here in Singapore. We are in or other countries in the region. So I'm thinking of gold also in Singapore dollar terms. And if you look at that, the price appreciation has been even stronger. Yeah. We are all very fixated on is gold is going to go to 2,000. Don't forget, this is in dollar terms expressed. If I'm sitting in Singapore, I don't care if gold goes to $1,000. I care where dollar Sing is and where gold is at that point in time. And gold only needs to stay where it is if dollar Sing goes to 165. In my terms, it has done what it is supposed to do. Yeah. So I think it's still advisable to increase the allocation to gold, somewhere 5 to 10% area, perhaps, given the increased geopolitical risk that we have. Yeah.
I think that's wonderful. Thank you, Thomas. I just want to reiterate the fact that we decided to do this for a small group. All of you have relationship managers. Please engage with them. So as a working professional, I have done this myself, where many a times not paid enough attention to readjusting portfolios or discussing certain strategies in line with the changing economic the market outlook. In a steady state environment, the cost of not looking at something is not high, but in the current environment, the cost or the price that one has to pay may be high because we may see extreme volatility. So do engage, do discuss. We hope this session was helpful in terms of just giving a very brief snapshot in terms of the good, the bad, the ugly. We can circulate the document as well, Barbara, we can do that?
Yes, absolutely. So we will circulate that with you as well as the presentation. And yeah, I think now it's time to wrap up. Thank you very much, Thomas and Swapnil.
Most welcome. I hope it was informative, the one or the other thing, and I'm looking forward to speak to all of you at some point in time in the near future. Thanks very much, and best of luck and stay safe, and have a wonderful weekend ahead.
Thank you.
Thank you.